and I think the amount of liquidity that has been put into the economy by the Federal Reserve and the government, I follow closely the monetary aggregates, the money supply. The M1 money supply has increased 25%, and that is far greater than in the entire year that followed the Lehman bankruptcy, and this happened in 8 weeks. So this is a liquidity-driven rally and an expectation that all this money that's accumulating is going to be spent as the economy opens up. And I think we're going to have inflation in 2021, and for the first time in 20 years, going to exceed the Fed's forecasts.
Oh, that's interesting. I'll touch upon that in just a moment, but I want to understand a bit more about your view on how the markets are expected to go higher from here. How much higher? Because even in terms of, the basic valuations, price to earnings multiple that the markets are quoting at, the opinion is divided there on the street on how the market is very quickly looking expensive.
Well, if we take a look at where it is versus last year's earnings, we're around 18 or 19. And in a zero interest rate environment, that is not too high. In an environment where I think bonds are going to be terrible next year and the year after, you want to have real assets. I think people are going to stocks. I mean, dividend yields are far higher on the stock market, even at these levels, than the interest rates on treasuries. So I think that's going to continue to attract money.
Okay, fair enough. Since you spoke about the M1 money supply going up by 25%, even more than what we saw in the financial crisis, and you believe that would stoke inflation next year, what would be different this time around? Because we've been in the same place in the past over the course of the last 10 years, and everybody said QE1, QE2, QE3 will all find its way into inflation, but it didn't. So what's different this time around that we can actually see inflation pick up?
Yeah, and that's a very good question, and it is very different. Last time around, the QE went into excess reserves of the banking system. There was just a little bit that got pushed into the deposits and was lent out. It was remember, before QE, banks had zero excess reserves, and then they had trillions. The Fed has provided excess reserves, but with the payment protection program, with the fiscal transfers, they're actually now putting those reserves. The banks are loaning and giving money, creating money into the pockets, bank accounts, payroll accounts, transactions accounts of individuals. That's what's different this time. And I was fortunate enough to have my first teaching position at the University of Chicago under the tutelage of Milton Friedman, and he told me, he said, money that is in M1 is far more powerful than money that sits as excess reserves in the banking system. And so that's the difference, and that's why we didn't have inflation from 2009 all the way through this expansion, but why I think it's going to be different in 2021.